Well, oil this morning has dropped from a two-year high after that surge in prices because of the unrest in Egypt. 8% of the world's sea trade, including crude oil, travels through Egypt's Suez Canal. Now I want to bring in our oil expert, Gianna Bern. She's the president of Brookshire Advisory and Research, an investment advisory firm that is focused on the energy sector. John and Sheila here with me as well. And Gianna, the question on everybody's minds today is whether or not this break in the oil price, is it a sustained break or is it just going to be temporary?
Well, I think it's going to be temporary for the moment. I mean, the wild card depends all what happens on the Suez Canal. Does the Suez Canal stay open and operable as it currently is, or are we going to see any disruption to transport in the region? So as we wait to see how the events unfold in Egypt and what the next government could look like, I think we're at a pause in the market, but certainly there's a lot of upward momentum. Friday, yesterday, I still think that we could flirt with some higher crude oil prices, and it all depends on what happens with the canal and if there's any disruption to transport supplies in that region.
Gianna, it's Sheila Dharmarajan here. You know, you look at Brent crude prices, you look at Saudi Arabia crude prices, they are still well at record highs. I mean, NYMEX is taking a little bit of a dip. What is sustaining those prices right now?
Brent crude, even before this crisis started in Egypt, Brent was trading very high. Brent was already pushing upper $98 per barrel even before Egypt erupted. And we've had in the North Sea some production delays, disruptions on the Osberg platforms, the Brent platforms. So already Brent was already trading very high. The spread between Brent and WTI had already widened to about north of $10 per barrel. And if you look between the disparity between WTI and Brent, it is very wide. We are near a $9-10 per barrel spread between the two crudes. There's been some pressure, increased supplies in the WTI market in Cushing. We have more Canadian barrels coming into the U.S., so we've had a wider Brent WTI spread even before this Middle East disruption started.
Hey, Gianna, this is John Erlichman. What about the bears? The bears had been piling into the oil market before this development, and we saw that with the Alaskan pipeline leak earlier this month and how we saw crude oil reverse course. How much of what's going on depends on whether you see those who were getting bearish on oil after the big move deciding that they want to cover their short positions?
Right. There were a lot of bears in the market prior to all of the Egyptian unrest. That's absolutely right. We've had a buildup in crude oil inventories. And don't forget, if we look at the fundamentals right now in the market, we still are very much at a point where we're above the 5-year average on crude oils. We're ramping up supplies on both gasolines and diesel fuels. So we're still at a point where we've got some fairly ample supplies, at least here in North America. So yes, the bears were very much in the market. The spread between Brent and WTI has widened to $10 per barrel. You've just not seen that in the last 20 years.
So in some ways, perhaps it was poised to fall at some point. This was the catalyst. Gianna, quickly though, if the Suez Canal is closed, what does that do to the price of oil?
Well, that's the wild card here. If the Suez Canal closes, I do think we're going to see some trading go up, because what that adds is transport and cost to the VLCCs, the very large crude carriers, the ULCCs, ultra-large crude carriers that will then have to go around Africa. It takes time, add 2 more weeks and cost, and I'd see crude oil prices trade up.
Trade up by what? Is there a way?
I'd say, you could see another $3 to $5 per barrel just on this unrest alone. I think what we're looking at is to what extent do we have additional geopolitical contagion throughout the region.
Gianna, thank you so much. Nice to talk with you, Gianna Bern, on oil. And we are